Hello, everybody, and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer. Today, we're going to be taking a look at Analog Devices stock, ticker ADI. This one came in by request in the comments of one of my other videos. If you have a request, put them down in the comments section. I'll get the ticker on the chalkboard behind me. We are stacking up some up there, but that's eventually I'll get through them. I've made hundreds of videos on here now, so some of them I'll post over on Patreon on the free tier, and some of them probably most of them I'll post on YouTube. Okay, as always, this is not individual investing advice, just how I analyze stocks. So Analog Devices, let's see what they do here. So manufacture semiconductors, focusing on analog, mixed signal, digital signal processing technologies. So core products, analog chips for things like temperature, sound, pressure, mixed signal ICs that combines analog and digital function chips, and digital signal processors. So applications, industrial automation, so like factory sensors, robotics, motor control, automotive, healthcare, consumer electronics, and communications. So pretty much anything electronic. So normally when let's back up just a little bit here. If you do want to try out Fast Graphs, I have a 25% off affiliate link down in the description. It can be useful, especially during the initial kind of phases of sifting through stocks. I need to make a new sifting through stocks video to add to the collection to kind of show you how I initially go through stocks. But if we shorten this up to just a couple years ago before we had this recent drop in earnings, the main thing I would go back and check for is how deep were these earnings declined. So in 2009, we have an earnings growth decline of 45%. In 2005, we have one that declines 26%. Then shorten this, we'll get year by year. And then we have a kind of a 2-year decline in 2012, 2013, where they went down 22%. We have a minus 3% in 2016, and 2019, negative 13, COVID year 2020, minus 5. So we have quite a bit of moderate cyclicality historically with this business. Now, typically, up until just recently, so typically, and when I first put this in my spreadsheet, I base my determination on whether to treat a stock as a deep cyclical or not based on how far these earnings draw down. And usually 50% is my level. I can make adjustments for these shallower drawdowns pretty easily. Basically, it just creates a lower earnings growth rate assumption because earnings aren't growing in a steady line, so you can adjust for that. But if they're more than 50% and the stock price decline correlates with that, let's see what theirs was here. So here's another example. So, because the choice is, do you want to treat this as a deep cyclical, or do you want to treat it as moderately cyclical, right? Moderately cyclical, we're going to use earnings to try to determine the valuation. Deep cyclical, we're going to abandon earnings as long as they're good over time. And we're going to look at the price cyclicality, especially if the price cyclicality is deeper than the earnings drawdowns are, right? So, or especially deeper than the market. So the market fell about 55 to 60% during this time here in 2008, and Analog Devices fell essentially the same amount, the stock price. So that tells me, based on this one recession, that it's not necessarily too much more cyclical than the wider market. It's not going to provide me this. It's not, if it would have fallen 75%, if the stock price would have back then, now I might want to think about how I go about things, because if I can buy it cheaper based on the historical price movements, then I can make more money. But what it shows right here is, at least during this drawdown period, it didn't fall any more than the market did. So that opportunity is not really there. And earnings aren't so cyclical that I couldn't model out an earnings model for them. So the reason I bring all this up is because it's in the semiconductor industry. They're almost always 9 out of 10 will be deeply cyclical. Okay. But occasionally you get one based on history that's not. So I usually defer to history if both earnings and the stock price are not more cyclical than the market or are not deeper than 50%. Then I usually don't treat it as a deep cyclical, and I use more of a fundamentally based analysis. Okay, so that's the setup. I've been tracking this stock for a long time. I probably even have a video out from a couple of years ago. I feel like I covered it once before, but I didn't double check it before I made this one. So now we get into a situation where things are a little bit different. Not completely different, but they look like they could be because we have this pandemic boom, okay? And then we have the bust that started last year, right? So earnings fell 37% off the peak in 1 year. We don't know where earnings are going to land this year. Analysts think they can grow 11%. We'll see, okay? If the economy rolls over, chances are this goes down another year. And so now we're getting into maybe that 50% earnings decline. But it's maybe mostly based on this boom and bust. So you just kind of have to look at this and kind of use a little bit of reasoning here. And one of the things I would do is say, okay, where were earnings before the pandemic? They were at $5.15 a share. And now, after the initial decline, they're at $6.38. This is the initial bust from the pandemic. Stimulus, mostly. Like pandemic plus stimulus. And you say, okay, how much real growth is that? What is that, like 20% or something? So over 1, 2, 3, 4, 5 years. So 20% over 5 years. If you drew a straight line, right? And we don't know if that's going to be the bottom. So there's not probably like a real strong underlying growth rate going on here. Now they did grow pretty good a couple years going into it. Obviously the boom years were good, but we want to be careful using the pandemic stimulus growth years, which is like 25% a year probably. And when the stock just peaked basically like at the end of February, and then it fell 30% in like a couple days. So the market was basically extrapolating this out or assuming that this pandemic bust would recover quickly. And then probably the tariffs got in the way of that. Now it's bouncing back. I don't know if they reported earnings or not recently or what's going on here, if it's just a natural bounce. Now, just eyeballing this, it looks expensive. If this isn't super deeply cyclical, it's trading at a 28 PE. Even if you modeled out what analysts are expecting, which is 11% growth, 22%, a lot of growth. If it traded at a 15 PE, you'd lose 20% over the next 3 years. So, and 15 might be a little low, but based on my earnings growth rate, which I think is like 7%, that's probably actually about right. So it still looks expensive there. Let's look at some of the numbers. Now there's a lot of kind of asterisks that go into this. So I have like a 7% earnings growth rate assumption for them. The key reason I don't have a buy price for them right now. Now, if you use that, the stock is extremely expensive. It's more expensive than the market. Yeah, it's they would have to get, now the market, because I'll show you why, the market is saying you're going to get, let's call it 15%, 16% growth over the next 2 or 3 years. And I'm thinking 7, right? So if I were to put 16 in here, it'll probably be like, I'm guessing 5.5, 6. We'll see, my spreadsheet loads. Like, let's just see what it comes out to. Yeah, like 6.25% 10-year CAGR. That's what this is, the expectation of the earnings over 10 years. The earnings CAGR, return for a business owner of the business. So, that's actually not too bad relative to the market right now. So the market, I'm going to say they only look forward a year. We saw it was 11% this year. If I put that in, that's pretty similar to what the market is, maybe 12. Yeah, that's right about where the S&P 500 is right now. So the market's basically looking at 12% growth this year. And then they're extrapolating that out forever without interruption, basically. Because you can get short-term treasuries for almost 5%, right? So the market is just looking at this year, extrapolating it out, and paying way too much, if you ask me. Although the one caveat of that is if we have certain types of inflation and these guys can pass that on, then it's better than fixed income, okay? Unless it's like really high yield or something. So it's a balance of that. And to me, if you have a stock that can fall, well, let's just look at how much it fell. When I checked earlier, it was like 30%. So February 21st, it's there. See, it usually goes by weeks. So a little over a month, it fell 31%. Is that the kind of risk that you want to take to get the same return as a little bit better return than cash? Not me. So now the main reason I don't, that's if I had a buy price on it. It would just be really expensive. It would be double what I pay for it probably. Now, if the reason that I'm avoiding it right now probably isn't a fair reason, honestly, and if I get this to load, I'll show you. Okay, so this number right here is 3-year revenue. So it's cumulative right here. That's a cumulative revenue growth over the past 3 years. And when that's negative for a non-cyclical business, or when we're not in a recession, that's a sign to me usually of disruption. And usually I sell steadier earning businesses when they have a negative 3-year return. So when I update this and I see that's negative, I usually don't even bother putting a buy price on it. That said, it's probably not totally fair to do that because these guys are moderately cyclical. I know we had a boom and I know we're in a bust. So I can go back and explain why 3-year revenue is negative. But I also know just by looking at it, it's expensive. So I'm not going to bother going through the extra work. So I don't think there's anything fundamentally worried about the business. I might even buy it if it got 50% lower. But it's just not anywhere close enough now where I need to kind of, concern myself with it. I don't know how tariffs are going to affect it. I can't imagine it would be good. So we'll just have to wait. And that's probably what the market's telling us, although did it bounce on yeah, it actually kind of bounced after Liberation Day. So maybe there's a situation where they benefit from that. I don't know. And maybe that's why it's up. I'm not really trading the daily tariff news. So we'll have to wait and see about that. But the fundamentals just don't look attractive relative to the price here, almost no matter how I look at it. But if it fell like 50% from here, I would take a look at it if there wasn't like a ton of other opportunities in the market. So I do track it. I keep an eye on it. It's just not super exciting because I feel like you're probably taking risk. I don't know if we can put up basic earnings, see how different they are. They're not too different, so that's fine. It's hard to get the reward, right, that you want out of a bit. So if you bought it here, and you held a while, you would have done well, but I could have bought other semiconductor companies and gotten double that. So if I'm buying them at the bottom, if I'm trying to, buy them really low. So it's like you can get good returns. There might be a situation where you can get better returns than this than something else. But if I have a choice, I'm buying the AMDs and the Nvidias and the Microns and I'm buying those because I can get so much potential better returns because they tend to fall deeper. And so that's kind of how I think about it. But, I never rule anything out, so I keep an eye on it. And if maybe there's some idiosyncratic reason that sends this stock price lower than the others, that might be a situation where I step in and buy some. All right, if you found this useful, hit the like and subscribe button. I have weekly picks over on Patreon for $25 a month and a free tier over there too. So go check those out, and I'll see everybody later.